With fire, now it's closing in. Nothing to bear and nothing to win. Nothing to win. Could you believe? Could you believe? Could you believe? Could you believe? Step in the fire, take my hand, I'll take you higher than you've ever been. Than you've ever been.
Thank you for coming on into the live and sharing your essence with me in this eternal moment of which we all share an inextricable and inexorable part. Thank you for doing your part, for coming on in each and every day, and we'll do the same without wasting a single second of your time. Bada bing, bada boom, we go into the charts. So it looks like as we held for the last 2 days, we were trying to close out higher time frame candles like the 5-day up above these resistance levels on daily time frames. You can go back and see where these touch on these daily time frames. I like to use daily time frame support and resistance lines. So this is a big range here that we have to reclaim to consider going higher. On the diagonal, also, this is where we came into support here, bouncing off of these daily time frame levels. So this diagonal pitch fan with the mean reversion path to the upside, we are seeing potential fatigue up in the institutional 70665 levels as we come down here. We broke above it, got up into the 786 and beyond 886 levels? And are we going to see fatigue at the 61865 level here and come down into the equilibrium level of 0.5? It would make sense to come and try to create some consolidation within this range to try to at least test these as reclaimed support before going higher. If it goes up here, there might not be a sustainable and be a huge drop. So if you want a sustainable gain, you should see some retracement in some way, shape, or form. Let's go see how the weekly candle closed. This could be the push to have the weekly candle. This is why we are staying here for the last 1, 2, 3 days. So this could be a way to try to reclaim this on the weekly time frame. Let's go see how the weekly looks. We still have a day for that to close before we go into the liquidity. So we have just a little bit of a sell-off wick here on the weekly, but if we try to get this to remain a higher high on the weekly time frame, we would need to stay within this range here at 30,270 to 31,055. So we would need to stay above 30k in order to maintain that higher high on the weekly time frame candle close. So could that be what we're doing to see the weekly close push off? We did manage to do that on the 5-day. So the 5-day and the 3-day have managed to close out higher highs on the time frames of the 5 and the 3-day. All right, so with those little tidbits in mind, we're going into the liquidity of high block. What is high block? Well, that's when people lock their liquidity in the charts to get burnt to a crisp by the market maker for not using a stop loss, and we get to see where those crispy characters lie in wait. And for the last few days, it's been the shorts getting the burn here, and we talked about this potential, if it does come up to here, that it could fade off of this $310 million character. But ideally, you do have a large amount of liquidity below. On the 1 minute time frame, you now have $30 billion imbalance to longs. So the pressure to the downside is getting greater. So the last time they started to drop out of this range, it pinged $310 million in short liquidity, which they came back with a fury to grab.
Fatality.
And they came back to those guys. And as of late, it's been kind of retracing down into the liquidity of the bursted $507 million in longs that pushed that up there. And they've been retracing into that with very little interest from the shorts, surprisingly. So it looks like the shorts as of this moment are fatigued. That means that the longs should suggest paying themselves. If they are fatigued, that is generally when it's safe for them to reverse without having to pay the most amount in shorts. Makes sense, right? The shorts get fatigued, and then that's when right at that moment they reverse it. And so they could be starting to come back into this liquidity down here at 178 million, down at 29,211. So coming down to this region to get this thick band of liquidity down here seems to make sense to me. And if you're that far, wicking down into the 29k is not that far away. So just as fast as we came up, we could come back down after taking out the pools, which is why we need to expand our vision to the higher time frame pools of the external liquidity range. It looks like in the last 12 hours there is more shorts to longs pinged in, but I don't use the 12-hour ping. Let's look at the 7-day. So on the 7-day time frame, we do have some shorts pinged in at 31,800 and 31,006, about $10 billion. They're chilling like a villain, ready to be taken. Although in the interim of this entire band to the downside, it is thicker liquidity down below. So a retrace down into this to at least scare out some longs and get these guys down here to consider paying themselves too would be in order. Let's go into the monthly time frame. Shout out to everyone here. Booyah booyah, 4 people, streamed condition looking healthy. After we switched up we had a typhoon and we switched up our internet settings to a lower setting, which was more stable but less fast. It seems to have taken out those jitters completely. Please let me know if we do have any speed bumps, if you will. That would be nice to know. All right, so on the monthly time frame, we still have a large band up here at 31.6, $13 billion. Double digits don't exist on the monthly time frame above that point. So you have two double digits up at 31.6 and 31.7 by 13 billion each, so $26 billion up there. And down below, you're all tapped on the long liquidity until you get down to 24.6. So this is just small liquidity pools, most likely on the 50x, 100x side that have things, and just getting people down here to close safely in profit would be the idea of the retrace on the monthly time frame. If you go to the 3-month time frame, we have previously taken out that pool at 31.2, $67 billion taken off on that surge up to this region.
Fatality.
Yeah, and they took out that pool here, and a $42 billion pool and a $50 billion pool up at 31.6. So these external liquidity ranges were the target of that push up. And are they still interested in what's above? 40 billion at 31.8, 55 billion, 32 even, and double digits sub 50 on the way up there. Not anything below, obviously, because they cleared it on that time frame. So the only liquidity pools down below in that same level are at 24k again, which is not likely in an easy manner. As you start to shift to the 6-month time frame, you still see those happy campers down here at 24.6, the $100 billion, $200 billion at 24.3. So you get all of these happy campers still in profit. I remember when they shifted out of here at the Silicon Valley Bank, they did leave some on the table. We did put that out there when we said the divergence would be spawned off the liquidity, and they don't always clear it. And yeah, they left those guys on the table as they shifted out with the fury. And yeah, that's about it for that time frame. If we go to the 2-year time frame, and then we were starting to see how this was shifting on the 3-month. We were saying these pools up at 32.1. We were talking about 32.1, I believe. It was it on the 3-month? Yeah, it was. No, it was 31k. We were talking about 31.2. We saw this getting hotter, and we were saying there was more liquidity to the upside than the downside when we were down here. And sure enough, we started to make our ascent. Let's go to the 2-year, where we can see that ambiguousness of the higher time frames, and also see all of the shorts that are still open from ages ago. From March 31st, 2022, for example, there's still pools up here, $80 billion in short liquidity up there at 50,000, for example. So you have all these marionette strings of shorts that need to be closed still that could gravitate price up. So the narrative structure previously, when we were here, some people were calling in February for like 36k, 40k, but the liquidity just didn't suggest it. It went all the way up to 29, and that's it. So in order to make the path to the upside, you have to make the liquidity path to the upside. So unless the path of liquidity is there, there is no narrative beyond that point. So you should only look at where the liquidity lies, and as of this moment, you do only have a path paved up to 36.4, but you do have that path paved for you. So 36.4 could be on the table as we see this path paved in nice liquidity pools, $159 billion at 32.4. It could be a surge up after a slight retrace, so be careful if you're in shorts. Look for reposition possibilities in longs perhaps, as there is pools still available, large pools on the external time frame of $159 billion if we reclaim that 32.4 area. And that would be reclaiming some of these regions on this drop from last year around this time, a year ago in June, with the cat ears drop out of here. All right, so that's it for the liquidity pools. Let's go into the charts of Binance and check out our momentum and fibs and see how it's going. So this is how the preemption of the curve gets you of the Momentum Master volume-based cloud. So we'll just throw on our indicators. Heads up display on, and what is this little bit of happiness? Link in the description for more, momentummaster.info. Scroll down to features, toggle everything you want to see, and you can hit the toggle switch or read about each component. So this curvature on the daily was what we were trying to preempt way back here last Saturday and beyond. We were saying we need to pierce above this cloud, and this preemption of the curvature is what you look for. In similar fashion here, this curvature to the downside could preempt this move to the downside. So the momentum waves, momentum indicators can be leading if you couple it with liquidity and market structure. So don't go solely off of momentum waves, but the momentum is hard to stop on certain indications, like a cross down event is hard to stop, a cross up event is hard to stop. So noting these crossover events and these cloud shifts on these higher time frames is something to note. All right, let's start our weekly analysis here, and then we'll try to keep it copacetic. So if we can close out a weekly candle above this adaptive moving average and above this weighting moving average, similar to what we just said within these support and resistance lines between the 30,000 region, then we start to make a higher high on the weekly and also start to reclaim some of these resistance moving averages, which were previous areas of resistance which took us out of here. Now also you're starting to see this baseline suppression that we were having to contend with for the last 7 weeks or so now starting to get reclaimed. So if you can reclaim these baselines have room to move up on the weekly and start to cross up for higher time frame narratives up to these regions. For example up in 36K. How did I get this 36K target, you say? Well, I did a trend-based fib extension level. We've been going over how to do that on the channel for quite some time. It's 3 clicks. So you do the impulse and the retrace. Here's the bottom of the impulse at 19K, top of the impulse up here at 31K, and the retrace that we just saw on the weekly time frame. So this is a weekly impulse retrace idea, putting you up in the 40K, 36 to 40K region of the weekly time frame play. This is a swing trade projection zone. So getting up into the 32,249 region would coincide you with those pools we said still exist on that yearly time frame, that 2-year time frame. So this external pool over here, you have that 32.4 region, $159 billion. So that $159 billion exists in that 0.65 region. So we could come up to that region and tap out some of that liquidity. It also coincides with the fair value gap here on that weekly time frame over there. So that's why I have this projection for the path continuing to the upside. You have this nice steady health of the cloud continuing on this bull run to the upside. We didn't quite get down to that 618 here, so I'm going to remove this for now. And let's take a look at the 5-day. All right, so the 5-day is meeting with resistance on the weighted moving average here. We did close out a higher high on that, so that within the 5 days of this 5-day, you can do a lot to retrace down and come back up, or just retrace, and it's happily made a higher high at this point, so it no longer could be supporting a move to the upside, although you do have this momentum wave occurring on the Momentum Master B. Cloud starting to taper just a little bit here, suggesting a slight taper of the momentum. If you go to the 3-day, sorry, it's getting hot in here. I have a soundproof room with the air filtration system, but it gets super stuffy if you don't have the air on. Let's see. So we have the 3-day time frame also closing out a higher high, and you're also in that resistance, that support and resistance range, so you could start retracing back. The cloud is starting to taper. Coming back to kiss the cloud would make sense on the 3-day. If you look at the momentum, we are getting overbought on the stochastic. The Williams, though, could continue to suppress the price here on the 3-day subtle support. We were talking about the subtle support of the 3-day and the 5-day having been oversold before, and how this money flow came beneath the RSI. The money flow coming beneath the RSI has been something I noticed. When there's this deviation between those two, they tend to gravitate back. The money flow tends to gravitate back to the RSI. Conversely, if the money flow gets above the RSI, it starts to deviate back to the RSI. This is why we put them overlaid like this. It's not to appear complex, it's because they actually communicate in some fashion that is noteworthy. So consider having those on if you have Momentum Master B. All right, so also we noticed the tidal basin, the double bottom tidal basin fertile crescent here of the oversold nature of the Williams, also suggesting that upside play. If you go to the daily time frame, let's go take a look. Daily time frame is getting overbought here on the stochastic. You had previous bullish divergence on the money flow, which triggered a stop loss hunt, which we went over as well. You got some nice oversold region in the Williams, now getting overbought. This ideally would come up some more before an alarm cross occurs for a complete reset of the daily. So watch out for a continued push up or suppression of the daily time frame as the weekly wants to close. Going to the 22-hour. 22-hour also is doing what we just talked, what we want to see the daily to do. When you have this separation between the Williams, this is what causes the suppression of the daily like this. So this is a preemption of what the daily would look like a day or two from now. You basically have, let's just go ahead and show you again. So the daily has this overbought, but the separation between the Williams average and itself suggests that it could keep going higher. So the suppression of this overbought status would look like this. Boom. So you get this suppression and this starts to gravitate up like this. I've seen it happen so many times before that that's what you wait for. And then when it gets to this point, then you could start to see these alarm cross events like this, where it starts to dump down. So now is the potential time where this might happen, where you get a retrace on the 22-hour for this to come down on the Williams. Definitely you'd want to see this come down to reposition in the long. If you are not in one already, you might want to consider paying yourself as this comes down, because if it comes down in a fashion, how much of that will it be? You can just consider re-entry at that time. All right, so if we go to the 22, definitely overbought on all oscillators. The leading MACD is also about to cross. You can set an alert for that on Momentum Master B if you have it. You go to this and you select add alert. You can choose pump or dump. It just means when it crosses down, it's a dump. When it crosses up, it's a pump. And you could set it for the higher time frame or lower time frame if you like. Currently, we're getting the baselines crossing, almost crossing, and prices closing above this. So we could get a cross down event on the 22 start to occur. I know we're already getting it on the 6-hour, the 12-hour, and not the 12-hour, sorry, but the 12-hour also doing the same thing. The 6-hour and the 8-hour are also having that cross down event. The 8-hour already crossed and confirmed, so this could mean the suppression is coming down to this super trend level down here at 28.7, or some of these fib levels 29.1. I had a liquidity pool down here at 29.3 and also at 28.5. So we could come down to these zones here on the 8-hour time frame, as well as the 12, starting to give that idea of fatigue as the candles are appearing beneath the baselines. What are the baselines? Well, they're your first sign of reversal. The baselines are one of the few leading moving average formulas available in trading. So go ahead and check those out. And yeah, we still have the healthy momentum to the upside on the 12-hour. So what we're saying is this is a retrace into these vector candles, these liquidity pools on the 1-minute time frame. Just like, look at how thick that is. That just looks ripe for the taking, particularly down to that 29.222 region. So we expect at least some sort of retrace after that nice, beautiful move to the upside. If we go to the 12-hour oscillators, also getting to that zone that we just talked about, where they're getting fatigued. does that mean it happens right away, or you have kind of meandering around before it happens? Meander. But even with the meandering, there is a level in which it goes down at, so that 7% drop is not a bad retrace to have. So even having 7% to the downside is a good little scalperoo if that's what your thing is about. And yeah, so seeing this 12-hour also get overbought on these higher time frames, the 12, the 22, the daily, all starting to get to that fatigue point. And the 6-hour. 6-hour has reset after some bearish divergence. You had some bearish divergence crystals print on that candle close there. That would have been a perfect short opportunity. Shout out to anyone that took that. You are getting this what is it, the alarm cross here potentially happening. Once again, when you get the Williams overbought like this, it's something to note, because it does start to suggest suppression or an unfulfilled 6-hour play, and then this could lead to downside on the 6-hour. So you got the 6-hour reset on the stochastic RSI, but if you're just looking at stochastic RSI, this is where stochastic RSI fails you, because the Williams in conjunction with the stochastic tells you that this stochastic lacks power unless this Williams resets alongside it. Having the conjunction of the stochastic and the Williams in that fertile crescent region is where you start to see the power of that. And then if you get the rising sun effect here, like the double bottom fertile crescent with the rising sun out of this tidal basin here, that with that oversold status, that's where you start to see its true power of the stochastic. But that's why we also overlay those. And it's nice that the Williams is in the negative domain and doesn't interfere with that, so we can visually see it nicely. If you're wondering how to use Momentum Master B, having it small like this is confusing for me as well, so I like to have it at least half, and then when I go into price action I get out of it. So everything's toggleable, just like this heads up display on my face. You turn it on and off, you don't need it on all the time. Alright, also we're at the outskirts of the Keltner channel, so at least coming back to confirm that in some manner as support or falling back into it is a reasonable thing to think on the 6-hour time frame with that cross down event. The bearish divergence could have already played out. The money flow is flowing down out of that. So here's where you start to see the oversold competition. So you have the overbought 12-hour, 8, 12, 22 daily, 8, 12, 22 daily overbought, and now the 6 and the 4 and the 1 and the 15, the 5, these lower time frames are starting to get oversold. So you have these overbought suppression powers of the higher time frame, and then the oversold nature of the lower time frames. Previously we had the inverse of that back here. We had overbought 4 hours here and overbought 6 hours, and then the higher time frame, subtle support of the 3-day, the daily, the weekly. These are the things that took us out. So as we took us out of here rather, but as we see this opposite effect, are the lower time frames not going to take off as much. They'll hook in liquidity and take off a little bit to hook them in and just hook, line, and sinker them below. The curvature of the 6-hour also suggests more downside here in terms of coming to a taper point where we come down to kiss for support. This could change at a moment's notice. This curvature also did not fulfill itself, but this is quite longer than before, so it could be one of those taper points to note. Cross down event is still in effect. We did have a cross down into a cross up here on that surge up on the 6-hour time frame. If we go to the 4-hour 4-hour cloud, ambiguously making its thick way up, still thick. We are making our way into the Keltner, doing what we just said should happen on the 6-hour. Everything's fractal in nature, so you'll start seeing the same patterns already occur, and you can see, okay, well, is that going to happen on the daily now? You're getting that. We talked about that extended M potential. When things are bullish before the short, they do an extended M. There's different M patterns that you have. The extended M is one that they like to do in bull trends because it stops out the majority of shorts before the real play plays out. Let's take a look here at the 4-hour time frames. Momentum Master B, we had previous bearish divergence on the RSI, which didn't played out. Is that going to get the suppression? The Williams is already opening up like a duck-billed platypus here. This angle suggests the flow of momentum trickling down onto this stochastic, causing it to get suppression and not take off. This is why if you don't have the Williams and you use just the stochastic RSI, you're going to see, why is it not working? This 4 hours oversold. And believe me, I've been there. I've seen it oversold and suppress in my face and knock me out of the trade. So this is why we added all these layers of confluence, which are backtestably true, to show you that this suppression could occur on the stochastic here, causing the 4 hour to not take off, because you have that the 5, the 15, the 1 hour, the 4 hour battling with the 6, the 12, the 20, the 8, the 22, and so on. So those kind of suppress it. You get that potential suppression of those using the Williams as your guide. And if we go to the 1 hour time frame, 1 hour time frame ambiguously trying to take off and failing, as we just said. So it's linking more liquidity in and pinging both sides. Williams ambiguously at the 50 level. Leading MACD crossed down back here and has remained crossed down on every bearish retest of trying to cross, suggesting the momentum continue lower as the domain of the leading MACD starts to come down to the Williams for a hard reset, perhaps on the hourly. We're still maintaining the structure of the super trend. What is the super trend? Well, it's this blue line from back here on Tuesday, June 20th. We've been holding it on the hourly ever since our ascent. Even coming down, we wicked off it, boom, and came off that to the T, wicked off it again, bing. So until we break that, the bullish trend on the hourly is still intact. So this is a really cool thing to help you either put your stop loss just below it into profit to guide you on the journey upwards or downwards in the opposite case, because those super trends back tested to be true are pretty good. You can edit them if you find better levels. Some people in the Discord have better scalping settings for that, but they're very useful. All right, so the cloud is above the price action here, starting to thin. So if you do see a surge up here, you could just come up to the top of one of these ranges to clear a vector candle, the bearish retest, and continue lower on the hourly time frame. This is a little bit ambiguous to express an entry in any regard, but just the cloud is giving you that impression of the thinning and suggesting that it will thin at some point and maybe retest it, and then that bearish rejection back down. Let's go to the 15-minute, and then we'll bid you adieu. So we're in the Asian session. It is the weekend. There is very little to be said about what can be done on the weekends, although they do send it sometimes using algorithms, so you could have some algorithmic plays in massive directions. It looks like over the weekend we just had a slow sell-off. So Asia likes to pump it before they hand it off to London, so they could see that pump, that bearish retest into the London handoff, and then New York sent it down, and then we've just been basically range trading in this range. So the 15-minute is starting to come down here with the hourly. The hard reset of the 15 is what we're looking for. I would like to see the suppression of these lower time frames to come retrace down into something on this time frame here. Okay, so the coming back down into one of these levels at 29.1, coming back to retest some of these ideas would be opportune. This basically fulfilled our projection and beyond, so I'm going to delete this. It's done. And now we can look for this as an impulse retrace. So we're looking for the retrace. How far into this retrace are we going to go? We already looked out the liquidity for you. The 29.222 region has a nice little pool that's thick band here for them to come back into, and then even further down at 28.6515 if it continues down that low. It all depends on how much liquidity they ping in here. As of this moment, they have pinged in more shorts to longs, but if you compare how many shorts they pinged in from back here to here just a day ago, there's less shorts, so they have fatigued the shorts. So that could be their signal to continue into this liquidity to get their money's worth while their shorts are on the ropes. All right, well, ladies and gents, that's a nice brief update. Hopefully it was worth your time, and I hope you enjoyed it. So thank you for coming on into the live and sharing your essence with me in this eternal moment of which we all share an inextricable and inexorable part. Thank you for doing your part, for coming on in each and every day, and we'll do the same, bring in the fire, the precision, the accuracy, and all that fun stuff, and we will catch you on the flip